Rahul Chadha joins us now from Mirae Asset Management. Rahul, fantastic to have you back. Thank you for joining us. Rahul, it's been just one of those patches where best of the bulls are astonished with the market rally. What's your sense? Do you think after a splendid July and June and July, August is going to be a good one? The gains, what we've seen, are they here to stay?
Okay, what we may see is some pullback, Nigun, because what's happening is markets are also debating how this fundraising for key banks is going to go through. So if we see favorable outcome on these fundraisings, whether it's for HDFC, Axis or ICICI, I think that's going to be a positive trigger for the markets. But more importantly, what markets are watching is data for July, August. See, June, everybody knew that it was a pent-up demand, and that's why data was good. But if this data holds on in July and August, which is really our base case, that it's going to be lower than June, but it's not going to be significantly lower than the June data, that's going to be reassuring for the markets. What's positive is clearly, like what we've discussed for last 4 to 5 months, is a global backdrop. The global backdrop of weaker dollar, strong stimulus by governments in Eurozone, in US is positive for global equities. And I think clearly a change in leadership is on cards. Last 5-7 years, we've seen money flock to US. That money is likely to move out to EMs in coming years as we see more and more signs of inflation coming through, dollar weakness, inflation coming back, the reflation trade coming through. That's more of a medium-term trend. I mean, if you ask me from next 1 or 2 months perspective, the data points for July, August, and the fundraising for the leading banks is going to be the key thing one has to watch from a markets perspective.
Rahul, having said that, US markets currently are largely dominated by tech giants. Apple was up 10% post numbers. Microsoft went up 5%, even though the base of the company is almost $1 trillion because they're planning to acquire TikTok. Don't you think there is a bubble there?
Of course, there's a part of a market which is frothy, and this is something we've been debating all the time, that there are COVID beneficiaries, all these names which have benefited from COVID, those are in a different world. Those names remind us of the tech bubble valuations in 2000. Those names define us remind us of the infra bubble in 2007-8. So that is the bubble part of the market. That bubble is getting built on because US 10-year is going down. But as people realize that, look, economic data is holding on, and which is what our base case from US was, that if you look at US, last 1 month number of infections have increased, but the eastern part of US, where large part of the economic data or large part of the economy comes from, New York, etc., is recovering well. And what we are seeing is most of the US also going through the humps, and the western part is also stabilized. So if your economic data stabilizes, then market would give away this utterly pessimistic kind of a situation or hypothesis, and then look at other stocks also, the COVID losers as they call, where there is deep value.
A minute on trying to understand what your view on banks is. Banks, in a sense, are a clear proxy to the economy. If the economy is struggling and the moratorium window is going to be creating some confusion on how each bank would be treating the NPAs, how do you think investors are likely to react to it? Because banks may do a great job of raising capital, but by raising capital in the short term, you're going to keep your return ratios diluted.
That's a great point, and which is where for 3 months there is fair bit of an uncertainty on banks, because banks are a proxy for the economy, which is where what markets will get comfort from is, look, where is the second derivative economic data going? So there, if we see the GST collections, though they've come down, but not significantly down. If you look at these e-way bills, they're reasonably decent enough. If you look at Maruti's July month sales, those are some points of comfort, but you need more comfort for one for banks to perform from here. And clearly, like the way you said, investors are genuinely confused about this moratorium numbers and these flexi loans which the banks or the financial institutions are giving, which is where the interest would be confined for the moment to the top 3 or 4 banks, basically. And then over next 3 to 6 months, as people realize that, look, the economic data is stabilizing, hopefully in about 3 to 4 months, we get some visibility on the phase 3 trials of these vaccines. And 6 months, we can have 300 million of these doses stocked up globally. That's where you'll see the performance from a cyclical part of the market. So from a 1 year, banks are clear outperformers. I think 3 months, they're going to be volatile.
Rahul, there are a lot of pockets and sectors which are doing much better than what they were, let's say, pre-COVID. Rural economy, tractor sales, digital economy, food companies or some FMCG companies. So what is your read of businesses which have become better, stronger and have emerged as clear winners because of the COVID crisis in India?
Okay. So again, the economy was in coming out of this slowdown, coming out of a downturn pre-COVID. If you look at the data around November, December, Jan, Feb, things were on the repair, things were on the mend. And I think that's where again, what we've seen is post a bit of a government support from Narega, etc. The rural economy is particularly come on well. So I think that's where autos look interesting. Why they look interesting is if you look at, again, the data points, even after some bit of a growth next year, we'll be at the levels, we'll be at the sales which we were there only 2 3 years back. So I think autos clearly look interesting. If you look at the pure COVID beneficiaries outside Reliance, which because of the geo or which because of the online retail has some bit of an internet tag, there are not many clear proxies in India. I think you get better proxies from a regional fund perspective in China, Korea, etc. But India, there are not many listed proxies.
Rahul, you sit in a region or in that part of the world where there is a political tremor. I'm not getting into why and the implications of that, but what does that mean for global investors who right now, if they're investing in China or markets in that region, they will have to deal with two challenges: economic slowdown and political tremors?
Okay. So first and foremost, obviously, what moves the market is the earnings or again, the confidence on the earnings recovery, and which is where I would say China was a bit ahead or the North Asian region because they handled COVID well. China, Korea, Taiwan were a bit ahead of India and ASEAN in terms of the earnings recovery. And that's why these markets have performed well. I think what you talked about the political challenges is more from a medium term perspective as markets get the confidence that look, the recovery in India and parts of ASEAN is a bit more steady, is a bit more sure. I think that's where the money would move. And what we've seen is weight of Hong Kong, China being nearly about 55% in the regional benchmarks. This is MSCI Asia Japan benchmarks, which is a exceptionally high weight. And as people get the comfort that recovery is getting broad-based, obviously money is going to move out of Hong Kong, China and go to other markets where risk reward is a lot more favorable.
You were bullish on pharma, and that call I'm sure has worked very well for you. Do you still remain bullish on pharma?
So in pharma, I think a lot of good news is there in price for the pharmaceutical companies, the generic pharmaceutical companies. Those are the Indian COVID kind of an beneficiaries. But I think if you take 2 3 year out, I think a lot of good news in the price. If one has a 1 year plus time frame, I think hospitals are attractive over there. That's part of the overall healthcare space, which is not participated in the rally, which is underperformed. These names may not do much from a 3 6 months perspective, but from a 12 to 18 months, they offer a handsome risk reward. I think pharma probably they can hold on well for next 3 to 6 months, but as you see cyclical recovery getting more entrenched in the economy, there are other sectors which will do well.
So Rahul, there are two ways or two type of companies. One which generate constant cash flow, which would include IT, some pharma companies, a lot of consumer names. And then there are second set of companies which are closely linked to the economy, which will do well if economy comes back, whether it is consumer discretionary, cyclicals and industrials. Which way would you lean for next couple of quarters now?
Okay, so if we take, let's say, next 3 or 4 quarters, in the first pack you said, I think IT is something one would be still comfortable with. This is a sector historically we've not been overweight because growth rate was slow. The legacy business was constantly under price pressure. Though you had digital revenues which were growing at 30-40%, but the legacy business was ensuring that the growth rates for most of these companies were mid to high single digits. I think because of the COVID and because of this big digitization push globally, their growth rates may improve in coming kind of an years. So that's going to be a significant trigger for these names. And also, these guys have shown a good ability to manage their SG&A costs. So in the first pack, which you said, which is high ROC, stable cash flows companies, I think IT clearly stands out even at these levels from a risk reward perspective. And outside that is really the play on cyclical recovery. So our portfolio is a balance of two. And as we get more clarity on the recovery, we'll tilt more towards the recovery play.
Line from Donald Trump which talks about cancellation of visa, how federal government will be contracting contracts to companies which do not take H-1B visa. Don't you think these are long-term structural changes which are likely to change the way how Indian IT industry is going to do business in US, and US is a large market, we all know that.
So a lot of these leading IT companies have been doing a fair bit of onshoring. If you look at government contracts, to the best of my knowledge, they're not more than 5% for most of these large companies. H-1B visa usage has been also reduced over the years. So obviously, again, we've got to get used to a world which is a lot more localized, where you've got a lot of government policy influence. But I think what helps these companies in the near term is that most businesses globally would realize that, look, if you've got to stay relevant for next 5 to 10 years, you need to have a omni-channel strategy. You need to have a good big data analytics framework. You need to have a good cloud framework. And I think that's where a lot of Indian companies should benefit.
We spoke about Reliance last time. That time Reliance was a 131 to 40 billion dollar market cap company. Now it's just gone to a different kind of an orbit. So as a fund manager, do you think this is the biggest challenge, because you cannot increase your benchmark beyond a point or exposure beyond a point, and Reliance has a weightage which now runs in 14-15%. So is it a very big challenge now to map a stock like Reliance for a fund manager like you who has to manage risk and cannot go extremely overweight?
No, you're absolutely right. I think in a regional fund, Reliance has done well because it's a fairly large exposure. But for an India country fund, despite having kept Reliance as the biggest holding, when the stock performs, it's a detractor. So obviously, it's a big challenge for us. To be fair, one wishes for the company to do well, but like the way you said, it's a challenge for us. And I think it just gets to a situation which we've seen in Korea, where Samsung Electronics is close to 20-24% of the Korean benchmarks, and the country's fortunes are very much linked to one stock. So it's not a healthy situation from a long-term perspective, and you need more companies to come.
Are you still excited about your exposure to insurance, because that's one space where you've been bullish for couple of quarters now? Do you think insurance companies are expensive, or they have a long way to go?
See, they've done well from the lows. They've outperformed the banks. So obviously, they're going to go through a period of time correction. But anybody who's got a 3 to 5 year time frame, I think these are good compounders. And we've continued to maintain our weights over there. We continue to like the space. But they may take a breather, having done so well from the March lows.
Will I be right in assessing that Rahul Chadha is not very bullish like he was next couple of months ago? In fact, if I look at the sound bites which I've got from you today, they are indicating more cautious rather than bullishness.
Okay. So I think 3 months back or 2 months back, one had valuations in favor. And obviously, that's where the bullishness came from. So a lot of those easy gains have been made. Right now, what one is watching is you're seeing signs of economic recovery. And as you get more and more visible signs of this recovery, that's where the cyclical part of the market, which is underowned, is going to give us money. What one is watching closely is these numbers of virus cases. If you look at the rate of compounding, in about a fortnight, our number of cases from India would be going to 100,000 cases. If you put a 2% mortality rate, the daily deaths are going to be 2,000. So one is not sure how would government react to this. If the government reacts in a mature way, builds up enough healthcare infrastructure and makes sure that those lockdowns are very regional, very limited time frame, then the economic recovery is on the way. But look, if the government gets too much worried about it, obviously the recovery would be impacted. So the easy money is behind us. Now we need more clearer signs, either on economic recovery or a successful vaccine, for us to make money in those sectors which have been negatively impacted from COVID, basically.
Rahul, you understand this more than anyone else that market price is a function of EPS and PE. Let's divide it into two parts, EPS and PE. Where do you think there is scope for EPS and earning expansion in next 12 to 18 months?
Okay. So again, first thing which I like to clarify here, Nikunj, you look at any kind of a recovery cycle. The first year is all about PE expansion. I mean, we did a study of last kind of a 5 to 6 recoveries. First year, 70% of the market returns come from multiple expansion, which is why we say markets are forward looking. And then the subsequent, you have earnings which come and follow through. So today, if we sit back and see the last quarterly season, honestly, it's not been bad. If you look at revenue momentum, obviously it's been weak, but we've seen IT sector where companies have surprised positively on the margins. We've seen cases in consumer also where you've got a bit of a surprise over there. Banks, obviously, this moratorium has created confusion, but if you look at pre-provisioning, the numbers are not that bad. So I think that's where we believe that, look, IT will continue with the good job. We may see a positive surprise coming from a bit of a consumer discretionary. And if we don't have severe lockdowns, then the financials can come and surprise also.
Are markets pricing in a second wave of coronavirus?
I think the second wave of coronavirus is already on. When we talk about this virus spreading outside the metros, I'd call it the second waves, or if you see these mini spurts in virus cases coming through. So I think a lot of corporates are also used to the fact that we, for at least next 6 to 12 months, we'll have an economy which moves in fits and starts. You'll have parts which get closed as the number of cases increase. Like we've seen in Hong Kong, last 2 weeks, we've had almost daily 100, 125 cases, and we've gone back to severe restrictions. But prior to that, it was as good as normal. So we may not get as clean second waves, but you will get the spurts, which are going to be a local spate of infections. And you need that maturity from policymakers to handle these infections well.
Rahul, what could China spoil the party for everyone?
I think what spoils the party here is ahead of US elections, the current government pushes a bit too much against China. If they do severe economic sanctions, if they control access to, and these are very remote tail risks, if they control this access to US dollar liquidity, that could spoil the party. Outside that, I don't think China wants to derail this economic recovery which is underway. The regime there gets legitimacy from economic stability and growth, so it's not in their interest to do so. I think if US does this, anything, I mean, we've seen President Trump currently trailing, and if he realizes that the best way to make a comeback is to capitalize on this anti-China sentiment in US and do something even more radical, I think that can spoil the party. Outside that, I think things look okay, like the way we discussed. In Europe, we've seen a bit of a second wave of infections, but it's not caused severe lockdowns. We've seen parts of Southern Europe go through a lockdown, but those are not severe. Similarly, if you look at eastern part of US, you're not seeing severe lockdowns go through. So I think it's the US-China relations, if you ask me, which is going to be the tail risk for next 6 to 9 months.
Right. So Rahul, closing comments. Where do you think right now it's time to exercise extreme cautious?
Time to see in India, you don't have those frothy tech names. If you've got exposure to US FANG, I would be worried there. Those are part of markets which have done well for 5 years. The market caps just cannot compound at these levels, 25, 30 times or percent for $1 trillion market cap. So I think those are excesses in US. There are excesses in some of the Chinese consumption names where valuations are 50, 60 times. Those are extremely momentum names. In India, we've seen consumer staples which are expensive, and those names have gone through this period of kind of a time correction. So honestly, if you ask me in India, probably there are pockets of overvaluation which would be somewhere in the pharmaceutical space, but I don't think there would be significant price correction over there. Those no names are not over-owned, etc. They've not done much in last 4 or 5 years. Staples, like the way I said before, are going through already this period of a time correction. So I don't think there is frothiness in India. If you look at foreign ownership also, which is what we've discussed before, Nikunj, it's the lowest overweight we've seen in 10 years. So from a technical perspective, Indian market is well positioned. I think as people get this confidence on economic recovery, economic data, and holding on despite COVID cases increasing, that's where you'll see more flows come into the country.
Uh, just to wrap it up with just one final question. In the short term, if you raise cash, there are chances that you may underperform because there is an element of momentum in the market. But will that be a prudent strategy to sit on slightly higher amount of cash and anticipate and wait for a correction rather than trying to chase the last 5-7%? Are we in that state of the market where it will be a prudent strategy to exercise some caution, sit on some cash? It could be slightly higher than what you normally maintain, but it could be well worth it.
I would disagree with that. See, in our funds, we're just keeping 1 or 2% cash because our point is you're still in the early parts of the economic recovery. You will get pullbacks, but those pullbacks are not going to be significant. Those pullbacks are actually the pullbacks to buy. And there is a change of leadership which is happening in market, which is why you want some bit of a more clarity for you to rotate out of names which are expensive, which are kind of and well-owned, to names which are under-owned and offer a favorable risk reward. So I think I would be more tilted towards this rotation or watching closely this rotation into cyclicals rather than holding cash. I mean, 3-4% cash any which way, it doesn't move the NAV for us basically.
Appreciate your time. We've really covered a range of subjects and a range of topics. So really appreciate your time. Stay safe, and let's certainly hope that we meet for a cup of coffee in person very soon.
Yeah, no, all the best, guys.